Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sana Biotechnology Inc. annual report. Sana Biotechnology Inc. is a biotechnology company that focuses on developing engineered cells as medicines for various therapeutic areas with unmet treatment needs. The company's product pipeline consists of several cell therapy products, including the company has developed several cell therapy products to treat different diseases. For type 1 diabetes, the company has U421 and SC451 in its pipeline, which are HIP-modified allogeneic primary islet cell product and stem cell-derived pancreatic islet cell therapy, respectively. These products are currently in phase 1 clinical trial and preclinical trial. In addition to treating type 1 diabetes, Sana Biotechnology's products also target other diseases such as systemic lupus erythematosus and Yensia-associated vasculitis, non-Hodgkin's lymphoma, and hematologic malignancies. The company has SC491, a HIP-modified allogeneic CD19-directed allogeneic CAR T-cell product candidate, which is in phase 1 clinical trial to treat systemic lupus erythematosus and Yensia-associated vasculitis. The company also has SG499, a C-date-targeted fusosome, which is in preclinical trial to treat patients with hematologic malignancies and B-cell-mediated autoimmune diseases. Furthermore, Sana Biotechnology has SC462, a hypoimmune-modified CD22-directed allogeneic CAR T program, which is in phase 1 clinical trial to treat non-Hodgkin's lymphoma. In terms of services, the company has an option and license agreement with Beam Therapeutics Inc. for use of Beam's proprietary CRISPR-Cas12 billion nuclease editing technology to research, develop, and commercialize engineered cell therapy products. The company also has a license agreement with Harvard College to access certain intellectual property for the development of hypoimmune-modified cells. Overall, Sana Biotechnology Inc. is a biotechnology company that provides several services including cell therapy product development, research and development of engineered cell therapy products using CRISPR-Cas12 billion nuclease editing technology, access to intellectual property for the development of hypoimmune-modified cells. The company's business includes providing these services to develop treatments for various diseases, including type 1 diabetes, systemic lupus erythematosus, Yensia-associated vasculitis, non-Hodgkin's lymphoma, and hematologic malignancies. Sana Biotechnology Inc. has experienced a significant surge in its stock price over the past year, with an increase of over 49.8%. This upward trend can be attributed to several key news events and developments that have reinforced confidence in the company's cell engineering platform and pipeline. One major factor contributing to this growth is the positive clinical data for U421 in type 1 diabetes. The publication of 1-year survival and function data in the New England Journal of Medicine has demonstrated the safety and efficacy of Sana's hypoimmune pancreatic islet cells, solidifying its position as a leader in cell engineering. Additionally, the company's advancement of SC451 program, which aims to file an IND application and initiate a phase 1 trial for type 1 diabetes, has also contributed to the stock price increase. The positive interactions with the FDA have further boosted investor confidence in Sana's pipeline. Furthermore, the progress made in Sana's in vivo CAR T fusogen platform, including first-in-human data for SG493 in CD19+ malignancies, anticipated as early as 2026, has expanded the potential applications of its technology. This strategic prioritization of key programs, while suspending investment in some allogeneic CAR T programs, has been viewed positively by analysts. The successful capital raising and extended cash runway have also played a significant role in bolstering investor confidence. The company's ability to secure substantial capital, including $133.7 million through an ATM offering facility and equity financing in 2025, has extended its expected cash runway into late 2026. Lastly, the positive analyst sentiment and price target increases have further contributed to the stock price increase. Several analyst firms have maintained buy or outperform ratings for SANA and increased their price targets, indicating a positive outlook on the company's prospects and pipeline developments. Sana Biotechnology Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $2 billion. Sana Biotechnology Inc. trades at a higher price-to-book ratio of 6.33 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 50% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes, such as buybacks or dividends, rather than operational deterioration. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for a company in the pharmaceutical or biotechnology industry are multifaceted. On the growth side, commercialization of approved products is a significant driver, as it enables sales, marketing, and distribution infrastructure establishment. Milestone payments, royalties, and other payments from future licenses, collaborations, or arrangements also contribute to revenue growth. Pricing structure and reimbursement from third-party payers are crucial factors, as they directly impact the company's revenue. Additionally, clinical trial enrollment and results play a vital role in regulatory approval and market acceptance of product candidates, leading to increased revenue. Strategic collaborations and arrangements with third parties support development and regulatory approval of companion diagnostics. On the decline side, net loss is a significant driver, as an increase in net losses from year to year can negatively impact revenue growth. Non-cash charges, such as stock-based compensation, also contribute to revenue decline. Research and development expenses are unpredictable and may vary significantly from quarter to quarter and year to year, further impacting revenue. Market opportunity and market growth estimates, competition from future therapies entering the market, commercialization strategies, and sales of common stock under ATM facility and public offerings can also impact revenue growth or decline. Overall, a company's ability to capitalize on market opportunities, manage expenses, and navigate regulatory requirements will determine its revenue trajectory in the pharmaceutical or biotechnology industry. The net income of the company has undergone a significant decline over the years. Initially, on page 76, it was noted that potential litigation costs and infringement of third-party intellectual property rights contributed to the decrease in net income. This trend continued as the company faced challenges such as disputes with collaborators and business combinations. On page 120, the decrease in net income was attributed to the potential negative impact from IRA and OBBBA on pricing and revenue, as well as uncertainty around regulatory approval for product candidates. The financial reports also revealed that the company incurred significant losses since inception, with a loss of $244.2 million in 2025, $266.8 million in 2024, and $283.3 million in 2023. The profit margins of the company have been affected by various factors. On page 76, it was mentioned that failure to achieve revenue and net income from collaborations may lead to a decrease in profit margins. Additionally, termination of collaborations could result in loss of future funding and payments, further impacting profit margins. On page 120, increased costs and complexity in completing clinical development and commercialization were identified as potential factors contributing to a decrease in profit margins. The negative impact on prices charged for products also posed a threat to the company's profit margins. As a result of its history of incurring operating losses, the company does not have applicable profit margins. The performance of various regions in the market can be identified from the extracted summaries. One segment that stood out as performing poorly is the European Union, EU. The EU's underperformance is noted on page 70. In contrast, international markets showed varied results due to differences in reimbursement and healthcare payment systems. This inconsistency highlights the challenges faced by companies operating globally. On a more positive note, territories outside of the United States performed well, as evidenced by their mention as potential locations for collaborations, page 75. Management is expressing caution about the company's outlook due to various challenges it faces. The company is aware of potential regulatory changes that could impact its business, indicating a need for vigilance in compliance matters. Financially, the company is struggling with recurring losses and substantial doubt about its ability to continue as a going concern. To address these issues, management is prioritizing certain product candidates while suspending development of others. Research and development expenses are expected to remain flat in 2026, but may increase over time due to successful clinical trials or expanding research efforts. General and administrative expenses will also be kept under control for now, but could rise in the future. Management is exploring alternative financing options, including equity or debt offerings, strategic collaborations, licensing arrangements, and other alternatives. This suggests a proactive approach to addressing the company's financial needs while ensuring compliance with accounting standards and regulations. Overall, management appears focused on managing costs, prioritizing product candidates, and securing funding to ensure the company's continued viability. The company has made several strategic acquisitions to enhance its capabilities and expand its portfolio. Notably, it acquired hypoimmune technology from Harvard, Fusogen technology from Cobalt Biomedicine, Inc., and gene editing technology from Beam Therapeutics, Inc. These technologies are expected to boost the company's research and development efforts. In addition to these individual acquisitions, the company also acquired Cobalt Biomedicine, Inc. in 2019 for $140.6 million. This acquisition is significant as it provides access to Cobalt's intellectual property and technology. Furthermore, the company has a license agreement with Harvard, which grants it rights to use certain technologies. On the other hand, the company has also made divestitures, including the suspension of development of 2 allogeneic cell therapy CAR-T programs. This decision is likely due to the company's focus on more promising areas of research and development. By streamlining its operations and prioritizing its resources, the company aims to maximize its potential for growth and success. The company's dividend policy has been consistent over the years, with no payment of common stock dividends. In fact, there are no plans to pay dividends in the foreseeable future. However, the company has utilized another method to return value to its shareholders, buying back shares through stock-based compensation programs. This approach allows the company to repurchase shares while also providing equity incentives to employees and executives. Concerns about inventory buildup or supply chain disruption. The extracted summaries reveal several concerns regarding supply chain disruption that could impact research and development. Global geopolitical, economic, and other factors beyond control pose a significant threat to access to animal models. Page 81. Trade restrictions, tariffs, and general economic/political conditions also contribute to supply chain disruptions. Pages 127 and 129. Furthermore, global supply chain issues affect the costs of laboratory consumables, supplies, and equipment. Page 138. Manufacturing, supply, or distribution shortages, as well as adverse changes in relationships with manufacturers or suppliers, are also potential concerns. Page 139. Additionally, natural disasters, geopolitical actions, trade restrictions, pandemics, epidemics, and infectious disease outbreaks can all disrupt the supply chain. Page 142. These disruptions could have significant consequences for research and development, highlighting the need for contingency planning to mitigate these risks. That concludes the financial summary for Sana Biotechnology Inc. Feel free to comment below, and I will be happy to answer them when possible.